So you have some extra cash and you are thinking about investing. You know you should probably do something with the money, but you're not sure where to start. You scroll through social media and suddenly it seems like everyone has an opinion. Some people are talking about stocks that double in a year. Others are warning that the market is about to crash. You hear terms like ETFs, dividends, dollar cost averaging, compound interest, and before long, investing starts to feel complicated, risky, and even overwhelming. And that is usually where most people stop, not because they are lazy or irresponsible, but simply because they don't know where or even how to begin. In this video, I want to strip all of that noise away. I'm not here to promise quick wins, secret strategies, or life-changing returns overnight. Instead, I want to show you a simple and realistic way to invest. One that has worked for many long-term investors around the world. But first, let's start with the most important question of all. Why should you even invest in the first place? The first and most important reason to invest is inflation. When your money is sitting in a regular savings account, or worse, Milo tin, it is not really growing. In many cases, after accounting for inflation, that money is losing value every year. Even if a bank pays you some interest, it is usually nowhere near enough to keep up with the rising prices. One simple example is food. 10 years ago, a plate of chicken rice might cost around $3. Today, it is closer to $4. The money itself did not change, but what that money can buy did. And that is just one everyday item. The same thing applies to transport, housing, healthcare, and almost everything you see in life. Now, imagine this. Let's say you work for 40 years and manage to save out $1 million by the time you turn 65. Assuming an average inflation rate of 2% per year, that $1 million will have lost almost 30% of its purchasing power over those 40 years. In other words, what feels like a large sum in the future could be worth the equivalent of less than $700,000 in today's dollars. This is why savings alone is not enough if your goal is to preserve and grow your wealth over the long term. In contrast, the stock market has historically delivered average returns of around 8 to 10% per year over long periods of time, which means by investing, you give your money a chance to grow faster than inflation instead of slowly falling behind it. The second reason to invest is compounding. Compounding simply means that your returns start generating returns of their own. You can think of it like chickens laying eggs, which hatch into more chickens, which then lay even more eggs. The longer this goes, the faster it accelerates. Not just that, the earlier you start, the more powerful compounding becomes. Take for example, Ben starts investing at age 25 and contributes $5,000 every year until age 35. After that, he stops completely and never adds another dollar. Joey, on the other hand, starts later at age 35. He invests the same $5,000 per year but continues all the way until age 65. Despite investing for a much shorter period and contributing far less money overall, Ben still ends up with a higher portfolio value of about $837,500 as compared to Joey's $616,700. Even if Joey increases his annual contribution to $6,000, it is still not enough to catch up. It is only when Joey invests $7,000 per year that he roughly breaks even with Ben. But by that point, Joey will have contributed almost 4 times as much money in total, simply because he started later. Many people think that the secret to investing lies in chasing the highest returns or picking the best stocks. But what truly matters is how much you can stay invested for and how much time you can give your money to compound. Now, once you understand why investing matters, the next question becomes, what should you actually invest in? Most beginners will naturally look towards the biggest and most popular stocks. In today's market, that usually means companies like Apple, Microsoft, Nvidia, or Amazon. Now, don't get me wrong, these are strong businesses and there's nothing wrong with them. But building a portfolio by concentrating only on today's top stocks can be a big mistake, especially for a beginner. That's because the companies that dominate the market today are rarely the same ones that dominate it decades later. If we go back in time, the top stocks in the past included names like General Electric, ExxonMobil, Cisco, and Nokia. Some of these companies still exist today, but many of them no longer lead the market, while others never recovered their former dominance. In other words, just because a stock is popular or dominant today does not guarantee that it will continue to deliver strong returns in the future. Besides that, putting your money into just a handful of individual stocks exposes you to significant risk. One disappointing earnings report, one technological disruption, or one major management mistake can significantly hurt your portfolio. So instead of trying to guess which companies will stay on top, what you want is an investment that automatically allows you to own the winners of each generation. At the same time, you also want something that always holds the strongest companies, gradually removes the weaker ones, while spreading your money across many businesses so that your portfolio has the best possible chance of growing over time. And that investment is an exchange-traded fund, or ETF. An ETF is essentially a single investment that holds a basket of stocks. When you buy one ETF, you are not just betting on a single company. You are buying exposure to an entire market, sector, or a group of businesses. Then, as the companies grow, succeed, and become more valuable, they will naturally take up a larger share of the fund. On the other hand, as companies decline, their allocation shrinks until they are eventually removed. Take the S&P 500 as an example. When you invest $100 into an S&P 500 ETF today, your money is automatically spread across 500 different companies. A larger portion goes to the biggest and most successful firms, while smaller amounts go to smaller holdings, sometimes down to just a few cents in companies you may have never even heard of. And because the index is constantly updated to reflect the largest and most valuable companies in the US economy, it naturally adapts over time. New winners enter the index, while companies that are no longer as competitive are gradually removed. This ongoing renewal is the reason why the S&P 500 has demonstrated a consistent upward trend over long periods of time. And this is also what makes ETFs so powerful. You don't need to predict the future, you don't need to constantly trade or react to headlines. All you need is the belief that over the long run, businesses will continue to grow, innovate, and create value. Then you simply stay invested and let time and diversification work in your favor. Now, while an S&P 500 ETF is a solid starting point for many investors and has even gotten the seal of approval from Warren Buffett Gong Gong himself, personally, I prefer to go one step even broader. Instead of betting on a single country to do well, I prefer to invest in a global ETF instead, where I bet on the entire world as a whole to do well. That way, I don't have to bet on whether the United States will continue to do well in the future. Instead, I'm positioning my portfolio to benefit regardless of which country will do well next. History has shown that market leadership shifts over time. There were periods when the United Kingdom dominated global markets, periods when Japan was the largest stock market in the world, and periods when the United States took the lead. So if history is any indication, no single country will stay on top forever. So by investing globally, I accept the fact that I cannot predict the future. So instead of trying to, I simply let diversification do the work for me. So for example, instead of investing 100% into US stocks, a global ETF today allocates around 63% of its portfolio to the United States. Beyond that, you also gain exposure to other developed markets such as Japan, the United Kingdom, Canada, France, and Germany, as well as emerging markets like China, India, Taiwan, and Brazil. Then, as the companies in the countries grow, innovate, and become more economically important, their weight in the index naturally increases. On the other hand, as others slow down, their influence gradually decreases. And once again, all this happens automatically in the background. What this means is that you do not need to predict whether the next decade belongs to the US, Asia, or emerging markets. With a global ETF, you are always invested in where the global economy is today, while steadily adapting to where it is heading in the future. So, how do you actually invest in a global ETF? Now, there are many global ETFs to choose from, and here I have a list of some of the more popular ones. Okay, I know this looks super complicated, but the main thing you need to pay attention to are the fees. The first fee is the expense ratio. This is the annual fee charged by the ETF provider to manage the fund. This fee is deducted automatically from your investment each year, so you don't have to do anything. Here, you can see that the expense ratio can range anywhere from 0.07% all the way to around 0.7%. At first glance, these fees may look tiny, but over long periods of time, they can quickly add up. For example, let's say you invest $100,000 for 20 years, and the investment grows at an average rate of 10% per year before fees. If the fund charges an expense ratio of 0.07%, your portfolio would grow to about $664,239 after 20 years. If the fund charges 0.15%, the final value drops to roughly $654,638. And if the fund charges an even higher 0.71%, the final value falls further to around $591,000. That is a difference of more than $73,000 compared to the cheapest fund, simply due to fees. This is why for long-term core holding, you generally want to choose ETFs with the lowest expense ratios possible. The second fee you need to pay attention to is the dividend withholding tax. To put it simply, dividend withholding tax is the tax taken away from dividends before they are paid out to you. For example, if you are a non-US investor investing directly in a US domiciled ETF, dividends paid by US companies are typically subject to a 30% withholding tax. This means that if a company pays $100 in dividends, you will only receive $70, while $30 is taken away. In contrast, because of a tax treaty between the US and Ireland domiciled ETFs are only subjected to a much lower 15% dividend withholding tax. So when you combine both the expense ratio and the dividend withholding tax, the list of global ETFs that have the lowest fee will narrow down to just a few names, such as IZ, AZWD, IMID, VWRA, or FWRA. Personally, I would lean towards FWRA. It has a low expense ratio and has a lower dividend withholding tax, plus it also trades with a relatively high volume, which means you will get tighter bid-ask spreads and easier execution when buying or selling. But then, how do you actually buy one of these global ETFs in practice? Now, because Ireland domiciled ETFs are listed in the UK exchange, you will need to get a broker that gives you access to the UK market. And one popular option here is interactive brokers. So let me just quickly show you how to buy a global ETF with it. Every ETF has a ticker symbol. So let's say if I want to invest in FWRA, I can simply search for this ticker on the platform. You will see several results, but the one you want is listed on the London Stock Exchange, usually labeled as LSE ETF. From there, the process is straightforward. You enter the number of shares you want to buy and choose your order type. If you want full control over the price you want to buy at, you can use a limit order. Otherwise, if you just want the trade to execute immediately at the current market price, you can use a market order. Once the order is filled, congratulations! You are now invested in a global ETF. Now, for most people, you can already stop here. A single low-cost global ETF is more than enough for the vast majority of investors. With one single investment, you get to own a small piece of thousands of companies around the world. Historically, a global ETF has delivered average returns of around 8% per year over the long run. That alone is already sufficient for building long-term wealth, especially when combined with consistency and time. That said, some investors may still want to adjust their portfolio based on their goals, risk tolerance, or personal preferences. And this is where additional allocations can come into play. For example, let's say with a portfolio of global ETF, your portfolio will give an average of 10% return over the long term. But then maybe you're comfortable with higher volatility and want to aim for higher long-term returns. In that case, you might add a growth-focused ETF on top of a global ETF. This can potentially boost returns, but it also comes with larger ups and downs along the way. Then, if you find your portfolio a little too volatile, you might choose to add an allocation like gold, which can help to reduce fluctuations during certain market conditions. Or if you prefer income, you might add some dividend-focused stocks or ETFs, such as Singapore banks and REITs, to generate regular cash flow. So you can mix and match based on your needs. But the core of your portfolio should ideally always remain a low-cost, globally diversified ETF. Then, as your income grows and your confidence increases, you can gradually add other allocations around this core. Next, let's talk about strategy. Because while having the right investments matters, having the right strategy is what really determines whether you can succeed over the long run or not. One of the biggest mistakes investors make is trying to trade in and out, like they are playing musical chairs with the markets or something. The problem with this approach is that it assumes you can consistently get two decisions right. You have to sell at the right time and then you have to buy back in at the right time. But in reality, even professional investors struggle to do this, let alone everyday investors like you or me who's doing this based on feelings. Most people do not lose money because they pick the wrong ETF. They lose money because they panic, sell at the wrong time, and struggle to get back in. And by the time things feel safe again, prices have often already recovered. That's why the idea of time in the market matters far more than timing the market. You do not need to predict bottoms or avoid every downturn. You just need to stay invested long enough for compounding to work. Missing even a handful of the best days in the market can significantly reduce your long-term returns, and no one knows in advance when those days will happen. Therefore, instead of trying to be the perfect musical chair player, a far more reliable strategy is to stay invested and make investing boring. This is where dollar cost averaging comes in. Dollar cost averaging means investing a fixed amount of money at regular intervals, such as every week or every month, regardless of what the market is doing. For example, instead of waiting for the perfect time to invest $12,000, you invest $1,000 every month. When prices are high, your money buys fewer units. When prices are low, your money buys more units. Over time, this averages out your purchase price and removes the emotional pressure of trying to time the market. But more importantly, it makes investing a habit instead of a decision that you constantly have to think about all the time. And guess what? You can actually automate this process to make your life easier. On platforms like interactive brokers, you can set up recurring investments so that your money is automatically invested into your chosen investments on a fixed schedule. Once it is set up, the process automatically runs in the background. You do not need to log in every day, watch the market, and decide whether you can buy now or not. This effectively removes emotion from the equation. When markets are up, you invest. When markets are down, you cry a bit, then you invest too. And over time, this consistency is what allows compounding to do its work. Because in the end, successful investing is not about being right all the time. It is about having a simple strategy that you can stick with, especially when it feels hardest to do so. Anyway, that's all for this video. Hope you found it useful. Like, share and subscribe as I'll be posting every week.